The United College Distinguished Visiting Scholar is made possible by the generous support of the College Endowment Fund. Under this scheme, United College is able to invite internationally renowned scholars to Hong Kong and to give public lectures to staff and students in college and universities. The college has much privilege to have invited Professor Stephen Figlewski from New York University as our distinguished visiting scholar this year. Without further ado, I would like to turn the floor to today's moderator, Professor Xin-Tong Zhang. Professor Zhang is an assistant professor in the Department of Finance of our university. May I now invite Professor Zhang to introduce Professor Stephen Figlewski and the topic for today.
Well, thank you, Gary, very much. Professor Jimmy Yu, Professor Steve Figlewski, and Mrs. Carol Figlewski, and all the guests. Good afternoon. It is my great pleasure and honor to introduce you our distinguished visiting scholar, Professor Figlewski, today to be the United College Distinguished Visiting Scholar for his second public lecture today. Steve is a professor of finance at New York University, the most famous business school, as you can imagine, the Stern Business School. And he received his bachelor degree in economics from Princeton University and his PhD in economics from MIT University. Okay, Steve is a globally well-known leading scholar in derivatives, and over his life of research, he has published more than 100 top journal publications. And for your information, I only published 3, so this is a big contrast. Okay, it is our great honor to have him today. And he is also the founding editor of Journal of Derivatives. Steve also has very rich experience at the industry. He has been consultant for a lot of industry practitioners like investment banks, and he also provide very, very important advice to the White House, for example. And the lecture today by Steve is about extracting market expectation and risk premium from the stock index options. This is one of the most important and also difficult topic in finance. Well, I know some of the students, I know you have very different backgrounds, but we are known for our curiosity. Okay, I hope you can get some exposure and some basic knowledge from Professor Figlewski's lecture today. So let me please welcome Professor Figlewski.
Good afternoon. Thank you all for coming. I have to start by saying that this is a terrific honor, I feel, to be a distinguished scholar for the entire United College. I'm used to giving seminars to, small groups of finance professors or maybe PhD students in finance, or maybe broader groups that would include master's students in finance and financial engineering and so forth. It's not very often that I teach undergraduates in the classroom, and I teach a course on futures and options, but it's not very often that I have an opportunity to speak to a broad group of people who, as I saw yesterday in the first of these talks, many of the people in the audience had not really seen some of the basic securities that I begin with, in particular options. Let me ask you at this point, how many of you were here for yesterday's lecture? Could you raise your hand if you were here yesterday? So most of you weren't. That's what I wanted to verify. What I decided for yesterday's class lecture was that I should start off by talking about the real basics of what is an option and what are some of the basic ideas that you really have to know in order to understand what I'm going to be talking about. All right? So I apologize to the people who were here before. Then I'm going to go over some of the same slides that I did yesterday just to get started. And I hope for the rest of you that you'll see that this is an introduction to the area of options and derivatives. I should say, I take this opportunity to thank United College and all of the faculty and administrators, the professors, the people who have made this possible. It's been a very interesting and exciting experience, and I hope you're going to get something out of my talk. Now, I have to tell you something. This idea of being a distinguished scholar, the term distinguished is always a little bit difficult for me, so I'm going to have to undistinguish myself a little bit just so I can get going. So if you'll forgive me, I got to take my jacket off. I can't. I get all excited when I'm talking about my favorite topic, options, and I walk around, and so I need to have some freedom of motion here. So let's begin with what a call option is, what an option is. What I'm going to be trying to get to is using the prices for these option securities that we see trading in the market, we can use those prices to extract the market's estimate of the probability distribution of what the stock is, the underlying stock is going to do in the future. You'd like to know, right now, I'm going to give you some examples, and in the example I'm going to be talking about, at first I'm going to talk about Apple Computer. And Apple Computer would be, in this example, is trading for $210 per share. All right. Now, if the stock goes up, if you own the stock, you're happy. If the stock goes down, you're not so happy. But you might like the ability to say, I don't know whether I should buy it right now at this price. Let me wait for a while, a couple of months perhaps, and decide whether, at that point, whether I should buy Apple at $210 a share. And in the meantime, the stock may have gone up, in which case I'd really love to buy it at $210, or the stock may have gone down, and I'm delighted to have the option not to own this stock when the price has gone down. All right? So a call option is the right to buy the stock on a future date by paying the price that's set today. And that price that's set today is called the exercise price or the strike price. All right? Now, if you buy a call option gives you the right to buy the stock. If you own the call option, you've acquired the option. You have 2 months to decide whether you should buy the stock or not. And if you decide to do it, at that time, the person on the other side who sold you that contract at the beginning, they have to give you the stock. If you decide you don't want to buy it, then they don't give you the stock. They have no right to make you buy the stock at $210. So these contracts are, well, I would say, what we're going to be doing is to take something that's a little bit exotic. An option is more exotic than the underlying stock. And I'm going to be talking about putting together options in ways to get information out that, well, the first time I heard it was possible to do this, I was really surprised. And then when I learned about that you really could do this, and in fact it's not so hard to do, then I got really excited. And this became my area, one of my major areas of research, my personal areas of research for the last 10 years. Right, so I want to share with you what this stuff is all about. Right, so here's the example I wanted to tell you. Suppose on August 20th, you look in the market, you could buy a share of Apple stock for $210. Or you could buy a call option that lets you decide later in the month of October, in fact, the day that these contracts that we're trading back in August, the day that these contracts are going to mature is this Friday, October 18th. All right. So on Friday, well, if you had bought This one. The October 210, 210 is this price that you'd pay to buy the stock if you decide to, and it would have cost $12.50. If you were ready to pay a little higher price, $2.15, well, that costs a little less. If you're ready to pay $2.20, that costs less still. If you take a lower price, obviously, that's going to cost more. And what we would say is that this one right here, the one where you'd buy at today's price, that option is what we say is at the money. Is at the money. Anything where you'd buy at a price that's better for you, like a lower price, $205 to $200, those ones are in the money. And if you buy at a price where the stock already has to get higher before you'd want to buy at that price, those ones are out of the money. All right, so we have 5 of them here. This is a small subset of the options on Apple that are trading. There are hundreds of them at different prices and with different maturity dates. A put option is the other kind of option. It's the right to sell the stock. So if you owned Apple in August, you might say, gee, this is a high price. In fact, if you follow Apple stock, $210 was a pretty high price. It hadn't been at that high for very long. So it seems like, gosh, if I had the stock, maybe I should want to sell it. But what if it goes higher? I'll be angry at myself if I do. So what might I do? Well, I might say, for $12.30, this price in the middle, let me see if this thing is working. Right there. Question, people way in the back. If I put a red dot on the screen, can you guys see it? Yes, yes, yes. Yes, you're saying, somebody says yes. Okay, good. I'm not going to do this very often, but it could happen, all right? So I might say, you know, I'd like to sell the stock, but I want some insurance. What if I'm wrong? What if the market goes down? What if, you know, anything. These days, one feels, thinking about what's happening in Washington, that anything could happen and you don't know ahead of time. So maybe I would just like to buy a put option that would say, no matter what happens, I can always sell at 200. The cost of that insurance would be $7.70. Okay? Well, now these days, in the United States, also in Hong Kong, I wanted to use some Hong Kong prices for you guys so that, you know, it seems close to home, but the options market is not quite so developed in Hong Kong as it is in the United States, and I have such an easy time getting data for the United States. So those are the examples I'm going to show you. These days, you can buy call options or put options on thousands of individual stocks. They exist for options on portfolios, and a portfolio of stocks would be maybe a group of stocks all from the same industry. So you could get stocks in the business equipment industry, or oil stocks, or precious metals, or something like that. You could buy an exchange-traded fund. I'm going to talk about those a little bit more later on. So that I want to buy a piece of the entire oil industry in the United States. That comprises a number of different stocks. But I can buy a single contract that covers the entire industry, and then there are options on that contract. So this whole area of options on things that you might be interested in investing in has grown tremendously over my professional career. One of the things that I found personally that I felt like I was in the right area was when I was an undergraduate, I was interested in futures markets. In those days, what people traded futures contracts on were agricultural commodities, wheat and corn, and my favorite was frozen pork bellies. Now, in those days, the futures market for frozen pork bellies was the most actively traded futures market in the world. Most Americans who I would say, what did you do? They would say, what did you write your undergraduate thesis on? Oh, frozen pork bellies? What in the world? But in China, everybody knows what pork bellies are, right? It's a major part of some important dishes. So that was my first introduction and interest. It basically is why I got into economics and then eventually into finance. But options were much more important, and options became important in the 1970s when I was in graduate school. So in 1973, Black and Scholes published the option pricing formula, the model that would tell you what the price of an option, one of these call options, should be, given some underlying things. How do we know that $12.50 is the right price for a 2-month maturity at the money Apple call option? Well, we have a formula that tells us what that should be. All right. The most popular options of all are ones that are options on the entire stock market. And the best measure of the stock market in the United States is the Standard & Poor's 500 index. It's an index, a stock index made up of the prices of pretty much the biggest 500 companies in the United States. Right? There's some slight differences. It's not really the top 500, but it's 500 stocks, and they're basically, you don't go wrong to think it's the biggest 500 companies. And the biggest companies have the biggest weight. So a company like Apple has got the biggest weight of any of the stocks in that index. Right? When we trade options on that index, we can take a position where if the index goes down, if we have a put option, we get paid. We make money when we have a contract that lets us sell the underlying stock or the underlying index at one level, and in the market it's a lower level, then we've got a profit. All right. The option pricing model that Black, Scholes, and a third professor by the name of Robert Merton developed in the 1970s is based on 5 parameters, just 5 parameters. Things that are perfectly obvious. The price of the stock. Apple is at 210. If Apple was at 220, the right to buy it at 210 is worth more. Right? The price at which you'd buy it, the exercise price or the strike price. The time to maturity. A 2-month option is worth more than a 1-month option with the same terms. The interest rate, and this is the interest rate on, not on risky stock, but the interest rate on risk, essentially zero risk, like a bank account, where the interest rate is set and you know what it's going to be. And the 5th variable is the volatility. Volatility is the one well, we think we kind of know what volatility is. And yesterday's lecture, I spent a lot of time talking about different ways of thinking about volatility. Volatility, when it comes into the option pricing model, is something quite specific. It's the standard deviation of the daily returns expressed as an annual rate. Now, I may be using some terms there that people aren't so comfortable with. The standard deviation is a statistical measure of how unsure we are. So a big standard deviation is, well, we have an expectation, a mean, the average that we expect, and the standard deviation tells us, well, how big a range might things fall into when we actually get to observe the thing we're worrying about. So the standard deviation of returns on the stock market, if the market goes up or down like 1% a day, that corresponds to a volatility of about 16% a year, which is sort of normal for the US stock market. Maybe it's a little bit low by historical standards. Volatility, though, is something we don't know for sure. We can predict it. We may have models for what the volatility should be. But no matter what model you pick, you stick it into the formula and you do the calculation. It comes out this option should be worth $11. And we look in the market and we see it's trading for $12.50. Well, we could say the market is wrong. We should sell that option because it's priced too high. Or we could say, the market doesn't agree with our estimate of the volatility, and so maybe the market's right. Maybe the market knows something we don't know. Well, with the formula, we can take the things that we do know, the stock price, the exercise price, and so forth, and also the market price that we see in the market, and we can solve backwards and get the volatility that if you put it into the formula, it's going to give you, the formula is going to give you the same prices we see in the market. And so this is basically where a lot of option market participants are going to get their estimates of volatility. They'll use implied volatility. And so this is the title of this talk is, let me see here, extracting market expectations from stock index options. Well, one of the things that I've just extracted is the market's expected volatility over the lifetime of the option, right? The implied volatility. And everybody's anybody who does options is pretty familiar with this idea. Right? Back in the 1970s, when this model was brand new, and also we had this strong feeling that, for the first time we were really thinking about the market as a mechanism for processing information. It's not just a place you go trade stocks, but it's a place where stocks are also valued. And the market has a lot of information. The market has more information than any financial econometrician is going to have when they're trying to calculate a volatility. So back in the 1970s, we thought, well, if we can find out what the market believes volatility is going to be, that's a terrific forecast. Right? That's better forecast than we're going to make. So that's what we used to believe. Turns out that it's not true. And it's obviously not true in it's not true in some very obvious ways. But it's also, as we think about it, we realize we really shouldn't, even in theory, expect the markets, the implied volatility you pull out of the option pricing formula, we really shouldn't expect that to be the market's best forecast. And I'm going to show you in a minute how this idea comes about. Anything you are going to extract from using market prices for options, any kind of information you're going to extract from that is called risk-neutral information. Now, that's a term that no one has heard probably in this room except for a handful of my good friends in the front row. Probably nobody has heard this term before, but within a few minutes you'll know what I'm talking about. I hope. All right. So what's wrong with implied volatility? Well, as I said, there's hundreds of different options, all tied to the same price of Apple stock. Some will let you buy Apple at different prices at specific dates in the future. Some will let you sell, but there's lots of them out there. But every one of them should obey this formula, where the one thing that you don't know is the volatility of the Apple price, the price of the Apple stock. And there's only one volatility, there's only one stock, there's only going to be one set of prices over time. And yet when we calculate these implied volatilities, when we compare them for different options, we find they're all different. And here's an example, not using Apple, but using the options that we're going to be looking at, options on the Standard & Poor's 500 index. What we're looking at here, the index is at some level here about 1110. The at-the-money option, the one that would let you get a payoff based on if the price is higher than 1110, then the difference between the high price, like 1200, and the exercise price of the option, that's going to be your profit. All right. So these ones are at the money, and the applied volatility for them is about 15%. These ones up here are out of the money, right? If this is out of the money they're in the money for a call option, you buy at 1,000, something that's already trading at 1,110, right? That option is in the money. But this end is going to be dominated by the put options, the ones that let you sell at those low prices. Those are the ones that are pushing the implied volatilities up. So if we look at the right to buy insurance against the stock going down below 1,000, well, the volatility that goes into that formula is like 25%. What does this mean? Well, it means a couple of things. It means one thing is that the Black-Scholes model can't possibly be right, because if it were right, every one of these implied volatilities should be about the same. But they aren't. Okay, so why? Well, this picture, this shape, is present all the time. In every market, we see it. Usually it's more symmetrical. It's more of a smile shape. It goes up further on the high exercise price side. After the stock market, and the stock market, U.S. stock market also looked like that too. After the crash of 1987, the shape changed to something that's more like this, much more asymmetrical. Sometimes you don't even see the end of it go upward. It's just downward sloping, and we call that the volatility skew. It's no longer a smile, it's a skew, or maybe you might call it a smirk. A smirk is sort of an asymmetrical smile. It's higher on one side than the other, like this. From time to time, I hear somebody call it a sneer. Absolutely not. It's not a sneer. A sneer is shaped like this, but this one is always shaped more cup-shaped, like a smile. Okay, so now, what I originally intended to do in this lecture was to start off from kind of where a student in my a senior undergraduate in one of my futures and options classes might actually be, and then kind of go on from there. As I've thought about this last night, I realized this is crazy. No, you guys aren't ready for that sort of stuff. I should do something that you'd maybe understand. So I invented a new example. I want to consider a very simple kind of investment. I'm going to invest my money with a coin flipping person. And the person flips a coin. And if it comes up heads, I get $100. If it comes up tails, I get nothing. All right, one flip. Well, we know how coins work, right? The probability I'm going to get a head is 50-50, right? 50% chance of getting a head, 50% chance of getting a tail. Those are the two possibilities. So the expected payoff on this investment would be, well, I got a 50% chance of getting 100, and a 50% chance of getting 0, so that says the expected payoff on this investment is 50. Right? So how about it? Are you ready to invest 50? Well, I hope not. Right? I want everybody out there to be saying, no, that's a terrible investment. Why? Well, because I'm taking risk and I'm not getting any kind of profit for taking the risk. Right? So this is how investing is different from gambling. In gambling, you like taking the risk. You'll even take the risk if it costs you something, if the odds are against you, because you enjoy the game. Investing should not be like that. Investing should be, if I'm taking a risk, I should be paid for taking that risk by getting a higher expected return. The return I should get should be whatever I could get in the bank with no risk, plus a risk premium. So if I can get 2% in the bank, maybe to buy stocks I should get 6%. 10%, depends on the stock. Right? So no, you shouldn't invest $50, not if you are averse to risk, if you don't like risk. And one of the deep principles of modern economics, modern finance, is that people are risk averse. They don't like risk. They have to get higher expected returns if they're going to bear risk. So you wouldn't do it. Right? Okay, what would you do? If you would want an expected profit, let's say 10%, would you do it? Would you do it if you had an expected return of 10% on the trade? I don't know. It depends on how risk averse you are. And it also depends on how much money is involved, right? You might do it for $1. You might not do it for $1,000. Right? So if we require an expected profit of 10% to accept this risk, well, we have an expected payoff of 50. So what we should pay is, well, our price should be such that that 50 we would get is 10% more than we invest. So how much should we invest? $45.45. If I can get into this game for $45.45, go ahead, flip away. Let me do it. All right? Whoops, wrong button. There. Okay, so the market price of this thing is $45.45. Now, here comes a financial econometrician, somebody who doesn't really know about this risk premium business that we've just been in, and they just look and they say, okay, well, here's a gamble. If you get ahead, then you get 100. Tail, you get 0. The market is pricing this at $45.45. So I can look at this and say, well, what must the market think the probability is that you're going to win, that you're going to get ahead? Well, let's work it out. $45.45 should be the probability of getting ahead times what you get if there is a head, plus the probability of getting a tail times what you get if you get a tail. And we can solve that and say, okay, from this, the probability of getting ahead must be a little over 45%. The probability of getting a tail must be about 55%. All right. Those are the implied probabilities from this price in the market. All right. So we know, because we know what the coin is about, that the true probability of getting ahead is 50%, and the true probability of getting a tail is 50%. But if we do the calculation the way I just said, looking at what the price is in the market and trying to say, well, okay, if there's no risk premium in this, what does the market think the probability of a head is? The market thinks the probability of a head is lower. Or the market is, to say it more accurately, the market is pricing this instrument as if the probability of getting ahead is 45%. So there's 6 different things that I want you to see in this example that are all going to be relevant when we go on to the next step. Whoops, one at a time. Okay, a risk-neutral investor. A risk-neutral investor is somebody who doesn't care about risk. They would pay 50 for this bet. Right? A risk-neutral investor is going to pay something equal to the expected payoff. They don't get a risk premium. A risk-averse investor will require a risk premium to invest. The risk-neutral investor and the risk-averse investor will pay the same price, that same $45.45, if the risk-neutral investor thinks the probability is 0.4545. Right? So we've got the risk-averse investor who knows the true probability is 50-50, but needs a risk premium and prices this thing at $45. And the risk-neutral investor doesn't care about the risk, but thinks that the coin is a little bit unfair. So the actual probability of a head is only 0.4545. Right? So we get the same price for the security for both people, right? But the implications for what the probabilities are different. Right? If all we know is the market price for this thing and the possible payoffs, we can calculate these implied probabilities. That's the 45%. We can calculate those risk-neutral probabilities. But we can't determine from just today's price and the future payoff, we can't deduce how much a risk premium there is and what the true market, what the risk-averse market's belief about the true probabilities is. We can't tell that. All we can see is this combination, this risk-neutral probability where the risk premium has been kind of folded into the probabilities. And the last thing to see is that, before I say that, let me say, why am I doing through this? Because I'm going to do exactly the same thing with options in a minute and be able to pull out a probability distribution for what the entire stock market is going to do at option expiration day. And that's a tremendous goal as far as I'm concerned. There's a huge amount of information in that, and we can get it from the options market. So what I'm trying to show you here is, well, what exactly is happening there? What are these risk neutral versus true probabilities? What is this all about? And so I hope in this simple example you'll see it. And the last thing to see is, well, we know something about risk neutral probabilities too. The risk neutral probability of the outcome we like, that is ahead, is lower than what we think the true probability is. And the risk neutral probability for the thing we don't like, the bad outcome, a tail, the risk neutral probability is higher than what we think the true probability is. And this is a general principle, that the risk neutral probabilities for bad outcomes are higher than we think the true probability is, and for good outcomes, lower. Okay, so now we want to apply this idea to the entire stock market. And it turns out that we can do this by analyzing option prices. Now, it would be really great if we get these risk neutral probabilities, or the risk neutral probability distribution of where the stock market is going to be, and we could take that apart into what the market really is forecasting and how the market is applying risk premia to modify what it's actually forecasting when we see the prices in the market. We want the market's predictions because the market has a lot of information. The market's forecast is going to be probably about as good as we can do given current information. And we want to know the risk premia because what that tells us is what are the cases, what are the outcomes that the market is most afraid of and most willing to pay insurance, to buy insurance from you. Because if you're not as afraid as the market, then you can make a profit selling insurance when the market really wants to buy insurance. The states where the market is pricing things too low, well, that may be opportunities for you to make a good trade. Buy things cheap. So if we can take this, we can extract this probability distribution from options, and what the hard part is to try and take it apart and learn things about both of the key things that go into it: expectations and risk preferences. All right, so that's the hard part. That's the part that I'm still working on, and I want everybody else to work on it too. All right. I'm going to skip this slide. It doesn't really say anything. There are two important theoretical results that are going to help us do what I've just said, to get this information out of option prices. One is a paper by Harrison and Krebs, 1979, and what they proved was that the risk preferences can always be folded into the true probabilities. And we use, people who do work in this area, use a certain kind of jargon that the true probabilities, the true probability that the coin has a 50% chance of coming up heads, that we call the P distribution. And I'm going to be kind of casual in my use of the word distribution versus density. I doubt that anybody here is going to be bothered by this. But I'll just say that those words don't mean exactly the same thing, but I'm going to treat them as if they do. Because it's hard for me to keep track of doing things exactly right. So there's the P distribution. That's what we think is really the true probabilities. And then there's the Q distribution. The Q distribution is a set of these risk neutral probabilities. So in the coin flip example, the P distribution is 50% for heads, 50% for tails. The Q distribution is 45% for heads, 55% for tails. this Q distribution, under this Q distribution, all securities in the world are going to be priced as if people were risk neutral. They didn't care about risk. The important thing is, it's the same prices as we're seeing. The difference is in terms of the probabilities. All right? So, if we want to figure out, well, what's a call worth, or what's any kind of security worth, under the P distribution, the true probabilities, our true guess of what the stock market is going to actually do, what's the payoff? What's the expected payoff? And now we have to discount that back to the present. Well, anything that happens in the future, we're going to have to discount by the interest rate. But we also want a higher return, the risk premium. So the riskless rate is 2%, so $1 a year from now is worth 2% less than $1 today. And the risk premium, I'm going to say, is like 8%. So that a risky dollar, a dollar that I'm not so sure about getting a year from now, I'm going to count as worth 10% less as of today. 2% for the interest rate and 8% for the fact that I need a higher expected return because of the risk. What Harrison and Krebs have done is to prove that in general, there is going to be this other distribution, this Q distribution, where the risk premium has been folded into the probabilities. And so we're going to evaluate the payoff, or we can evaluate the payoff under this Q probability distribution, and then discount that at the riskless rate. So this is what somebody who was risk neutral would do. They wouldn't apply a risk premium, but they would have these risk neutral probabilities. And what Harrison and Krebs showed was that you can always do this. You can always bring the risk neutral probabilities into, you can always bring the risk premium into the risk neutral probabilities. The second major result, Breeden and Litzenberger, they proved that you can extract this Q distribution from a set of option prices. So, although we can't observe the market's true beliefs, we can't observe this P distribution, and we can't observe the market's risk aversion either, but from the market price of the options, we can learn the Q distribution that combines the two. And you don't have to assume a model to have that, to get that. And that's quite an amazing thing. All right? I'm going to skip this. Oh, but I did want to say one thing. So the true probabilities of the P distribution, what do we call the true risk preferences? Well, those are expressed in terms of the ratio between the Q distribution and the P distribution. So that is called the pricing kernel. I apologize for giving you these terms, but they're going to be kind of important because next thing I want to show you is one of the major things that bothers people about this whole area. Right? In our coin flip example, the Q probability is 0.54 for a tail, was 0.5454. The P probability was 0.5, so the ratio of the two was 1.09. The probability, the pricing kernel for the outcome of getting ahead, the Q probability is 0.4545. The P probability is 0.5. So the pricing kernel is 0.91, right? So, so how does this thing actually work? For actual options, how can we get these probabilities? It seems like magic. All right. Well, imagine, see, now we have to start with call options. Imagine we're talking about one call option that lets you buy a share of the underlying stock for a price of 101. So if the stock price is higher than 101, let's say it's 105. Well, you'd pay 101, you'd buy a stock worth 105, and you make a profit of 4. If the stock price is 110, you'd pay 101, you'd buy the stock that's worth 110, and you make a profit of 9. If the stock price is low, 90, well, you wouldn't exercise the option. You wouldn't buy the stock at all. All right? So this table here, the first line of the table, gives you the payoffs on that option with a 101 strike for each of these stock prices. In the market, the price of that option is $5. Now we got another option that has a lower strike, a strike of 100. All right? In the market, that one's trading for $5.70. Well, if we look at the different payoffs, if the stock price is 101, the 101 strike call doesn't pay anything. But the 100 strike call, you'd exercise it, you pay 100, you get a stock that's trading for 101, and you make a $1 profit. If it's 105, you make a $5 profit. If it's 110, you make a $10 profit. And as you look at this, for every price at 101 or higher, the second option pays $1 more than the first option. The market prices that second option at a price of $5.70. So getting an extra $1 if the stock price is above 101 is worth 70 cents. So roughly speaking, the probability you're going to get that $1 is 70%. You got a 70% chance of getting that extra $1 and a 30% chance you won't get it. Right? And so that means that the 100 strike option is worth 70 cents more than the 101 strike option. And you just saw how, just by comparing the price of those two options, I get the market's estimate that the probability the stock's going to be above 101 is 70%. Well, if we have a lot of options with different strikes, we can fill out the entire probability distribution between the lowest strike for the options and the highest strike that's traded in the market. That's what I'm going to do. And that's what I've been doing for a number of years to get that Q distribution. All right? So here we're looking at three things. The red should look like a nice normal distribution. On the horizontal axis, I have standard deviation. So this is like in this range between -1 standard deviation and +1 standard deviation is about 65-67% of the probability is right in there. Another 15% of the probability is between 1 and 2 standard deviations away, and about 2.5% of the probability is way out here in the tails. All right. This one I worked out on February 3rd, 2014 for the options that were going to mature about 2 weeks later on the third Friday of the month of February. All right. This black line is the Q distribution. The black line is the one that I've extracted from the options market, from those options on that day. All right. And we can see, well, the Q distribution is higher down here in the far low tail. The market has really gone down, and if this happens, and the Q probability is higher than the P probability. Over here, the market goes way up, the Q probability is lower than the P probability. And that's exactly what we expect to see, because the Q is going to be higher than the P for the things we don't like, market going way down, and it's going to be lower for the things we do like, the market going way up. So at the two ends, things are looking good. But in the middle, this is crazy. This is the pricing kernel, and it has this bump in it. Now, what I've said about this is the Q distribution should be higher than the P distribution for the things you don't like. That's all prices where the market has gone down. and it should be lower for all the things you do like. That's all prices where the market has gone up. And so it should, across the whole range, it should be downward sloping without any bumps. And anybody who does this is going to find that bump and is going to say, where is that coming from? This doesn't make any sense at all. How do we rationalize this? This is the pricing kernel puzzle. All right. I'm not going to solve it either, by the way, but I just want to say, this is something that people are all worrying about. And I'm hoping that, the kind of stuff that I'm doing, and that, of course, you guys are going to be doing when you get down to doing research, that you're going to figure out what's going on here. All right? But just to show you, I did this for a 2-month thing, starting in October and looking at December options for 3 years in a row. This was 2006, and this was a period where volatility was really super low. And you can see how tight that distribution is. All right? People didn't think much was going to change at all between the beginning of October and option maturity and the third Friday of the month of December. This is the next year. This is 2007. Interestingly, October of 2007, this was about the highest the stock market ever got up to that point. So we're really right up at the top of the market here. You see it's a lot wider, and maybe it's my imagination, but it does look to me like there's more probability down here of the market going down than in that earlier picture. Guess what? A year later, the market really did go down. In 2008, in October, the market was, as we say in technical terms, it was in the tank. The market was in terrible condition at that point. People were scared to death. And see how wide the spread is. The standard deviation was huge at that point. People were buying options that would not pay off unless the market went down 60% within the next couple of months. It seems crazy, but just to give you an idea of how much difference this can be and how interesting it might be that you can do this. So to summarize, the risk-neutral density is often called the Q density. That combines the market's estimate of the true probabilities with the market's risk preferences. Risk preferences are captured by this pricing kernel, which is the ratio of the two. We can observe the Q density in the market. We would really like to be able to separate out into expectation, true expectations, and risk aversion. All right. All right, so I just told you about the pricing kernel puzzle, and that's what those two slides are about. There have been a lot of efforts to try and explain this. I have a couple of things that it seems to me we're leaving big important things that we're leaving out of our modeling, and one of them is that over the years, when we've been building models, everybody knows the stock market is made up of people that have all kinds of different expectations, a different risk aversion, and so forth. Everybody's different. But we saw very early that under general conditions, you can kind of aggregate everybody together, and the market is going to behave the same way as if everybody was the same, and had sort of average risk aversion and average expectations. And we saw that when you're building a model, that is a very, very useful assumption, a useful condition. And we don't have to worry about all the diversity of everybody in the market. We can kind of lump everybody together into one representative investor that's all the same, right? But here, our representative investor is behaving in a weird way, and this is not unusual. This is every time you look at this, and in every market you get this, and it shouldn't happen, but it does. Well, I want to step back a little bit and say this idea that we can price things as if everybody's identical, that's really useful, and it's okay for the stock market maybe. But for any kind of a derivatives market, a futures contract or an option or something like that, that's a contract. That's between people, two individuals on either side of it. It's a zero-sum game. So if I buy an option and I make $1, that dollar comes to me because the guy on the other side of the contract lost the dollar. All right? If we add up my profits and his losses, they're always going to sum to zero. And no matter whether the stock goes up or down or sideways, it's always going to sum to zero. All right? So if everybody's the same, they're not going to take opposite sides of this contract. No one would ever trade a future or an option or anything like that. And in fact, when we start thinking about the model of the reasons for these markets to exist, the main reason for a futures market to exist is so that people can hedge. That is, people who don't like risk but are stuck with it can get rid of it and give it to a speculator who's ready to take on the risk because they expect to get a profit from it. The whole purpose of the market is to facilitate the transfer of risk from one group of people to another group of people who are different. So to say, oh, it's the same as if everybody is the same, the whole market disappears. Nobody would ever trade. We might agree what the price should be, but no one would ever take a trade at that price. So that's a big problem, I think. And I think that I would like to imagine that at least that's part of what's going on with this pricing kernel puzzle, that we're seeing the market is aggregating information from people who have very different expectations. And if I have some time, I'm not sure if I'm running low on time, and the thing, I keep fiddling with my phone because I had a timer going, but it keeps turning off, so I don't really know how long I've been talking. I assume that when everybody gets up and leaves, then I'll have to stop. Possibly even before that. So let me show you what I did with this kind of pricing risk-neutral densities idea to kind of look at different expectations, different classes of investors. Right? Now, it's possible to buy an exchange-traded fund that's tied to the Standard & Poor's 500 index. Now, I bet that there's a lot of people here who don't know what an exchange-traded fund is. If you imagine, the Standard & Poor's 500 index corresponds to the value of a portfolio of 500 stocks, the top 500 stocks in the right proportion, so the biggest stocks have the biggest weights, the smallest stocks have the smallest weights. There's a lot of money that is being invested passively just to buy that index. There are mutual funds that, financial institutions that hold that portfolio, and you can put money, deposit money with them. So Vanguard, for example, invented a lot of these things. They also have more recently put together, you put together a whole portfolio of all of those 500 stocks and then sell shares on that portfolio. And so that's an exchange-traded fund. It's traded, the shares on the portfolio are traded like shares of stock in the stock market, but what you're buying is not a partial ownership of IBM or Apple or General Motors. What you're buying is a partial ownership of this portfolio that looks just like the Standard & Poor's 500 index. These are super popular products. They're called Standard & Poor's Depository Receipts, SPDR, SPIDERs, and the ticker symbol is SPY. And I'm going to be showing you things that show SPY. That's what we're looking at, is from options that are tied directly to the Standard & Poor's 500 index. But people really like this. So there's other exchange-traded funds that give you twice the payoff on the index. If the index goes up 2% today, these ones should go up 4%. If the index goes down 1% today, these ones should go down 2%. There's also ones where it's as if you sold the stock short. So if the index goes up, you lose money. And if the index goes down, you make money. And there's ones where it's short and also leverage. So if the market goes up 1%, you lose 2%. If the market goes down 1%, you make 2%. All right? Now it seems to me that somebody who is going to invest in an exchange-traded fund where they're going to get twice what happens to the Standard & Poor's 500 index, they're different people from the people who want to buy a fund that gives a negative twice for this, what the Standard & Poor's index pays. But both of these, all three of those exchange-traded funds have a complete set of options trading on them, and you can get risk-neutral probability distributions out of them. So that's what I'm going to show you. The SPY, that's the one that I just said. This is like buying a piece of the Standard & Poor's portfolio. The SSO, that's the double long position. It's like you got twice as much exposure. And the SDS, that's the double short. All right, so that's how these things are going to be identified. And here are the things. Two details about actually extracting this probability distribution. One is you can't do the whole thing. You can only do the part from the lowest strike price to the highest strike price. So on the Apple stock, it's trading at 100, 210. There might be options, a call option that have a strike of 100. And 110, 120, so forth, up to 300. But not at 500, not at $20. Right? So you can only get the middle part. You don't get the tails. And what that means is that you can't estimate, you can't calculate exactly from the probability distribution. You can't calculate the kind of statistics that we're used to, like the mean, the standard deviation, and so forth. All right? So how do I deal with that? Well, instead of looking at the mean, I'm going to look at the median, the 50th percent. And instead of looking at the standard deviation, I'm going to look at the spread between the 25th percentile and the 75th percentile. And that's going to be pretty close to the standard deviation, but I don't have to have the tails to do that. All right? So here's what happens when I get these. There's three of these things. This blue one, this is for the SPY. This is for the risk-neutral density that comes out of these, the spider options on that invest in the S&P 500. This is the one, is the double long. Right? Now they're in different places because what we're talking about is you're buying like a share of the index, and the shares are trading at different prices. So the SPY, the share is trading at like 130, and the SSO, the double long, the share is trading more like about 80, and here's the double short is trading more like about 50. So to be able to compare these, I got to do two kinds of transformations. One, all three of these things are based on the Standard & Poor's index. So I want to convert them all to be how they would behave, or what they're saying about the probability distribution of what the S&P index is going to be. And the second thing is, I want to convert the x-axis from prices into price changes in terms of standard deviation, so that I can compare periods where the market is going up and down 1% a day with periods where the market's going up and down 2% a day. Standard deviations converts this all into actual probabilities. All right? So here's what these things look like when I put them all together. All right? The blue one, that's the single long S&P 500 portfolio. Compare this one with the double long. Well, the double long is higher probabilities for small gains, lower for small losses. But we got sort of this bump over here. What's the bump about? Well, to my mind, what the bump is about is the people who are really super bullish and they want to buy the double exposure, they really think the market's going to go up. And they want to have a payoff if it does. So they're really eager for this. They don't think this is likely to happen. They don't think the market's going to go down a little bit. They don't think it's going to go down a lot either, but if it does, they're in trouble. Right? If the S&P index drops by 4% in one day, they're going to lose 10%, or they're going to lose 8%, and that's a big loss. And so they want some kind of protection. They would maybe buy put options that pay off if this really bad thing happens, and so we can see that maybe in the picture. The red is for the double short. They think there's less chance that the market's going to go up. They think there's more chance the market's going to go down. So I like this picture. And I'm going to skip the further analysis of it because I just talked about it. Come on. So now how would we take this stuff apart? We like to take it apart so that it tells something about risk preferences. It tells something about the market's true estimates. And I tried a couple of things to like that, but I'm not so happy with what I have so far, so I'm not going to show it to you. Right? But what I did do, which I thought was quite interesting, and I am going to show you, is I say, well, I don't know how much of the risk neutral density is expectations, and the difference is how much is expectations, how much is risk aversion. But let me just try this thing. I want to look at, for each of them, as a function of what today's return was, how did things change? And the kind of questions I want to ask is, okay, I'm a guy who has one of these double long exposures. What do I do when the market goes up 2% today? Do I say, this is terrific. I knew the market was really strong. It went up 2%. That's even more than I expected. I really think it's stronger now. So am I going to expect, if it went up a lot today, am I going to expect it's going to continue going up more than I expected before? We would say that would be called extrapolative expectations. I'm extrapolating what happened. That's going to keep going on in the same direction, right? Well, on the other hand, maybe the reason that I want this double exposure is I think the market right now is at 2,800, and I think it's going to go to 2,850. Well, today it went up to 2,830, so it's nearly there already, and it's still got 2 months left to go. So from now, if it's going to keep going up to 2,850, it doesn't have to go so much, right? So I might think, well, it's gone part of the way there, so I don't have to, so that now I expect it's going to go up more slowly from here, right? So that would be kind of, I'm not sure what to call it, regressive expectations or what, but in any case, people would be, they would be expecting that if what they were anticipating already has happened, then there's less of it to happen in the future, all right? So what happens if the people who've got long positions look like they're really right? What do they do? What do the people with short positions do when they think they're really right? And if they're right, do they become more confident about their abilities? Because we see a whole probability distribution. We can look not only at what they think the expected return, the median of the distribution, but they go say, well, also they become more confident. They think they're right, so the standard deviation or the spread goes down. Now, if we compare the double long with the single long, the person who's just holding something that looks like the S&P portfolio, well, we would expect him kind of to behave the same way, but maybe not as strongly. And the double short guy, if the price goes up a lot, well, now he's confronted with the other problem. I was really wrong. What does that mean? Does it mean that the price has gone up, so I think it's going to continue going up, so I'm expecting less probability that it's going to go down? Or does he say, the market was bad. It went up today, so now it's even more of a sell, more reason to sell than I had yesterday. All right? Well, I'm getting really low on time, and I was going to show you this table, which everybody knows that when you got a big room full of people, you never show them a whole table full of numbers. Nobody was ever going to live through something like that. So if I can, having looked at my timer and discovered I've already gone over time, I'm gonna blast through this thing and just tell you what you should see. That now the things in here, what we're looking at is the change in the median if today's return was low positive, medium positive, between 1 and 2 standard deviations up, or really strong, up 2 standard deviations or more. This side is going, the market going down a little, medium a lot. And each line, there's each thing, there's 2 sets of numbers. This is how much the median changes. In these cases, it goes going up a little bit. And the ones in parentheses are t-statistics, which if you know statistics, this is a measure of how confident we are that that coefficient is not just plain 0 and right? So anything over 2 in parentheses means that this is significant. And something by the time you get up to 4 or 5, these are really super significant, right? Okay, and the first 2 rows, this is what the single long investor does. These 2 rows are the double long. This is the double short. So the single long, the double long, they have extrapolative expectations. If they have a big up today, they're going to expect it, their expectation of returns tomorrow goes up. Comparing them with the single long people, the single long people show about the same kind of thing. They've got positive numbers here so that their estimate, if today's return is really big, they're expecting more big returns in the future, and that's highly significant. But these numbers, comparing between the 2, are much smaller, so that the effect on them is much less. The double short guys, what they find, they have the opposite response. If they have a really big move, down move, they're saying to themselves, exactly what I was expecting. Now it's over, so I'm not expecting it to go down further. Right? The exactly opposite of what the double long guys were thinking. This is what do they do when they're wrong? And when they're wrong, both the longs and the shorts begin to worry. Right? The double long guys, they show extrapolative expectations. So the market goes down, well, they think, well, maybe it's going to, they're less bullish than they were yesterday. The double short guys, though, the market goes down, and they get more confident that they're right, and they're expecting it to go down even further. And here's the last one. If people are right, these are the ones here, if they're right, then the spread gets narrower. They become more confident. If they're wrong, the spread widens out, they become less confident. Right? So this is where I am at the end now. There are 2 major areas in which our theories about risk-neutral densities are really inadequate, and we really need to know more. One is we don't really understand how risk premia come about. Most academic pricing models ignore risk premia entirely. That is not appropriate, I feel. And we need to have some accounting of the fact that investors are different, and the markets are doing more than just putting a price on something. They are aggregating information and putting good prices, I should say, on the securities that are being traded. So let me just say, I've enjoyed this talk. I hope you got something out of it. I'm sorry I took so much time and kind of squeezed our time for questions, but I'd be happy to answer any that you would like to pose. Thank you. Now I'm going to put my... being unpacked here. Yeah?
Thank you, Professor, and please sit in the front. So I'm sure that there will be some questions on the floor. So may I now once again invite Professor John, the moderator for today's lecture, to host the Q&A section for us.
Well, thank you, Steve, very much for this very fascinating talk. At least I learned a lot. Even though I spent the last 8 years doing derivative research, still I believe I only understand like 10%. of the whole universe because there are so many things to explore. So I really enjoy your talk so much. So I would like to give you one question that is in my mind for a long time. Okay, so sometimes we observe the market is changing all the time and there are so many participants with very different opinions. And do you think the corporate managers, like suppose I'm a CEO of Apple, I look at so many different opinions that I can extract from the market. Do you think the manager should actually respond to those different pricing needs or different opinions? Or what is the true kind of situation or true risk premium for Apple in that case?
Well, thank you for asking me such a simple question. There were a couple of parts to it as I was thinking about it. One was should investment managers try to respond or take into account market sentiment or market opinions that may be available. Did I understand you meant from like Facebook and Weibo and well, I think the basic answer is they should take into account absolutely everything that's relevant, and so that surely is relevant. How do you take into account that information that can be extracted from that stuff? I think we're just at the very beginning stages of learning how to do this, but some of the most interesting and exciting work that I see going on around involves just exactly that. I have a couple of colleagues who have, Johannes Strobel is leading a team of people who they have an inside deal with Facebook, and Facebook is giving them data, information, and people to help them analyze it too, and they're doing all manner of interesting things like looking at connections between people who are in different parts of the country but are facing the same basic decision about interest rates have gone down. Should I pay off my home mortgage and refinance at a lower rate? And this is a big decision for people, and most people, it takes a long time to kind of think your way through this. But what they find is that people who are connected by Facebook friendliness between like Boston and California, they're a lot more correlated in what they're doing with regard to refinancing their mortgages. And it's just like one little tiny area, but these people are very productive, and I think we'll be producing all kinds of interesting results. And this kind of information is available in different kind of venues. And yes, I think researchers definitely should be studying this. And if researchers should be studying this, maybe there's money to be made. Who knows?
I see. Okay, thank you very much, Steve. Actually, because I'm doing related research, so I benefit a lot from your opinion as well. It shows that you are encouraging me to go along that line. So thank you so much. And so, can I leave any question? Is there any question from the floor? I'm pretty sure there will be, yes.
Thank you, Professor. I have a question about the P and the distribution P and Q. When you change the original distribution P to the risk-neutral distribution Q, you assume that the only factor which influence the P to Q is about the risk premium, but I'm not sure why this. I'm not sure is there any other premium such as the liquidity premium will influence this, because if under such a strong assumption that we ignore other premium.
Yes, I thank you for that question. The way I would think about this myself is that the term risk premium is just sort of a general term referring to differences between this. One thing that I've done that I didn't show you, well, obviously I had too much that I could say and not enough time to say as much as I might have. Well, I'm afraid I've lost my train of thought on this one. But your question was, are these, oh yes, now, should we call it all risk premium? And one thing that I did was, yesterday I was talking about volatility, and there are different ways of thinking about volatility and different aspects of price changes that might matter to some investors or some market participants more than others. So, for example, if there's jumps in prices, then that makes it really hard for market makers to make markets properly in options. Right? If the price is jumping around, it's very hard for them to make good prices in options. And so I calculate the implied probability distribution, the Q distribution, calculate the standard deviation under that distribution. So what's the standard deviation what is the risk-neutral standard deviation? And then I tried to see, well, is that affected by things that you might think people would care about? Like, for example, if yesterday was a big day with a wide range of price movement, does risk aversion go up, or does the Q distribution implied volatility does it get bigger? Yeah, that's not that kind of behavior is not something that we would use to try and calculate the volatility of price returns, but we can see that, hey, this is something that matters to people. Here's another idea. What about I'm using a model to predict volatility. What if I see that my model isn't working very well right now? My model is making big errors. Well, does that change my risk-neutral volatility? And the answer is yeah, it does. All right? Now, is that a risk premium? I'm not sure. I would strictly call it a risk premium, but it's something where the Q distribution is being affected in a way that this P distribution, the true probabilities, might not be. All right? So it's more calling risk premium is more like a shorthand way of just talking about the differences between what goes into the pricing of options versus the underlying probabilities that govern the price of the stock.
Thank you very much. And any more questions from the floor? Yes?
Joseph, of course.
Student of finance and novice investor. I would like to ask a very simple question. You have talked about the ETF, the double long, double short ETF, that when the market rises a lot or falls a lot, then it seems to be the fact that it shows that the people are getting more confidence of their bets for and against the market. Is this simply a manifestation of the confirmation bias in behavioral finance, that people, once you get the trend, you get it right, you think that keep on being right? The second question is that as an investor, how do you translate this in theoretical framework into profitable transactions in the market? And then the third question is where you're talking about volatility. It's basically an ex-post analysis. Implied volatility is calculated after knowing all the parameters. Then how do you again ask the question, how do you actually profit from the analysis when you only be able to do it on an ex-post basis rather than ex-ante basis?
He has 3 questions.
Yeah, I like the second question, but I'm trying to recall exactly what it was. It's too much to ask you to ask the second question again. That would make it a 4th question.
The first one is about confirmation bias.
Yes. Oh, yes. Confirmation bias. The first question was about confirmation bias. Are people rational? The real question is, when they're right and they become more confident, are they being overconfident, or is that a rational reaction to being right? And I can't answer that based on what I have in my data, This whole area is something that as soon as I get home, and we're going home in a couple of days, I'm going to start working on this stuff. So this is my next line of research. Maybe if you come next year, I can give you some more results. But I'm inclined kind of to agree with you that it may be more not entirely rational. People become more confident, but maybe they shouldn't be. You know, maybe they're becoming overconfident. It's those of you who have not actually done a lot of reading about this, it's been established that human beings as a species are overconfident. We think we're too smart. We think, 75% of people think that they drive better than the average, that they're smarter than the average, that they understand economics and finance better than the average. And obviously that can't be true, right? But everybody is very overconfident. And there's even a theory I've heard that says that we'd better be hardwired to be overconfident, because otherwise we'd never walk out of our caves and when there's saber-toothed tigers wandering around. So, maybe we have to be overconfident, and I wouldn't be at all surprised if that's at least part of what we were seeing. Oh, but you wanted to, the question that I liked was, how do you translate this into money? And the difference between the Q distribution and the P distribution is going to tell you where is the market pricing things different from expectations. In other words, if the market really hates one outcome, the Q distribution is going to be a lot higher at that outcome than the P distribution. The market would pay you to take risk. The market will pay you a lot to take the other side of a contract that pays off when that bad state of the world happens, and not otherwise. And so the difference between the Q distribution and the P distribution will tell you where is it a good place to be selling insurance, and where is it maybe a good place where you have a good expected profit and the market is not charging you enough for that. All right? So that's kind of what but I haven't, like I say, this is the sort of thing where I really want to start looking at how do you get information out of the difference between these two things and so forth, but I haven't done that research yet.
All right, I think because of the time, we have to stop here. And once again, I enjoyed Professor Figlewski's lecture so much, and I hope you have done that as well. Once again, let's thank Professor Stephen Figlewski for his wonderful public speech. Thank you so much.
Thank you, professors. To express the appreciation of our college, we have prepared souvenirs for both the speaker and the moderator. So may I now invite Professor Jimmy Yu, the college head, and Professor Helen Mang, chairperson of the Distinguished Visiting Scholar Committee, to present the souvenirs. Professor Yu and Professor Mang, please. First, to our Distinguished Visiting Scholar, Professor Figlewski, to receive the souvenir. Also, we would like to present a souvenir to Professor John. Thank you all. On behalf of United College, we thank you again for attending this lecture and wish you all a nice evening. Thank you and goodbye.